Welcome back to New Post today. Let's continue with the most important points that you need to keep track for July 22nd for the upcoming UPSC preliminary examination of 2025. So it was on this day that the wholesome budget was introduced in the parliament, and therefore let's see some of the components of the budget today and also the articles in the Constitution of India which deal with budget. Now we have three tiers of government, that is the central, state and the local governments. Every government presents their own budget. So what exactly is a budget? It's nothing but a statement of the related expenditure and revenue. It is nothing but the accountability of the executive to the legislature of the manner in which the money is spent and also the taxes are garnered. So there are certain articles that deal with the budget in the Constitution. Now the budget is not called budget in the Constitution, it's called as annual financial statement, and it is included in Article 1112 of the Constitution. So it says that the budget is placed by the President, but the President placed the annual financial statement before both houses of the Parliament on the last day of the Friday or the first working day thereafter. So this is what is said. After it also says, the same article says that the budget should distinguish the revenue expenditure from the other expenditures. Therefore, we have a revenue budget and a capital budget. The revenue budget deals with the revenues that are mobilized by the Government of India, and apart from that, the immediate expenditure which is done from the revenue that is mobilized in the form of taxes. The capital budget looks at long-term investments, long-term revenue, and also it distinguishes the immediate expenditure from the long-term revenue. Apart from that, the revenue expenditure does not create any assets or liabilities, but the capital expenditure does create assets and liabilities as well. So if you look into Article 1114, it says that the Constitution requires the government to prepare a separate account of receipts and expenditure of the Consolidated Fund of India, which includes revenue of the central government and certain other funds, and also the money received by the government through the loans as well. We have the funds created in the Parliament, and therefore it says that we have the Consolidated Fund of India, Contingency Fund of India, and apart from that we also have the public accounts of India. Now the revenue receipts, now as I told you, there are two parts of the budget, that's the revenue budget and the capital budget. The revenue receipts consist of the tax revenue like income tax, corporation tax, GST, customs duties and the excise duty. The non-tax revenue consists of interest receipts and dividends, and the capital receipts consists of the debt receipts like the borrowings, and the non-debt receipts which include the interest receipts and also the dividends as well. The revenue expenditure is mostly in the salaries, subsidies and the pensions. I told you these do not create any asset or liabilities, but yes, capital expenditure creates assets and liabilities. So it's debt payment, machinery, roads, buildings, infrastructure. So your infrastructure expenditure actually comes under the capital budget. So these are some of the main components of the capital budget. Apart from that, we have revenue receipts which are the income tax receipts, profits of public enterprises, grants, etc., and capital receipts are of the above which I just told you. What exactly is the tax revenue? Now there are two types of taxes, direct taxes and indirect taxes. So direct tax revenue is levied on the individuals and the firms. The indirect tax revenue is actually the burden of impact is or not on the same person, but it is shifted to another person, mostly the consumers. Direct taxes include income tax, corporation tax, wealth tax, gift tax. Indirect tax include your value added taxes, excise duty, customs duty, service tax and the GST. Non-tax revenue includes your commercial revenue that is received by the government in the form of prices paid by the people for the goods and services that the government provides for the people, like electricity, railway, etc. Administrative revenue, which includes accounts on administrative services of the government. They are as follows, like fees in the form of passport fees, governmental hospital fees, education fees, court fees, fines and penalties, license fees and permit, escheat, income that the government get by taking possession of the property, interest receipts and profits of public undertakings. The capital budget includes higher amount of expenses than the revenue budget. Now the capital receipts include your borrowings, recovery of loans and disinvestment. What exactly are borrowings? Borrowings are of two sources: your domestic borrowings from the domestic financial market by issuing securities and treasury bills. It also borrows from the people through deposit schemes like provident fund schemes, small savings schemes and national savings schemes as well. And apart from that, external borrowing. Now external borrowing is done by the government through various other countries, and apart that is the foreign governments and also the international organizations like the IMF and the World Bank, etc. Recovery of loans. What exactly is recovery of loan? Now, quite often state and local governments borrow from the central government. These loans are recovered by the central government from the state and the local government and are capital receipts in the budget, because recovery of loans reduces the assets, that is the debtors. And disinvestment. Now, resale of the shares of public sector undertakings. This is a very recent source of capital receipt of the government, especially from 1991. And in government-owned enterprises, the government owns 100%. When it sells a share of the PSUs, it is called as disinvestment. And the extreme form of disinvestment is total devolution of 100% ownership, and that is privatization. Now, the expenditure is revenue expenditure and capital expenditure. Revenue, when the government incurs expenditure to create assets like schools, hospital buildings, roads, canals, railway lines, reduces its liabilities such as repayment of loan. Such expenditure is called as capital expenditure. But when the government incurs the revenue for neither creating of assets or liability, but only for administration, for example, payment of salaries, employments, maintenance of public property, providing free education, subsidies, health services to the people, it's called as revenue expenditure. Plan and non-plan expenditure. Now, after independence, we adopted the path of planning towards achieving our economic development and our goal. Under planning, we made a distinction in the budget for the expenditure to be incurred every year. Such expenditure is called as plan expenditure. Now, plan expenditure is catering money to the plans, the programs or the schemes under the planning component of the government. Besides plan expenditure, government also incurs the routine expenditure such as expenditure on police, water, electricity, sanitation, health, maintenance of legislative bodies, maintenance of executive bodies, maintenance of the judiciary bodies, etc., government departments, etc. This routine expenditure is called as non-plan expenditure. Looking from the point of view of the nature of the budget, we have a balanced budget, a surplus budget, and a deficit budget. A balanced budget is one in which the revenues and the expenditure are equal. Now, a deficit budget is one where the expenditure exceeds the receipts. Now, there are two types of deficit. Yes, so we have revenue deficit, that is when the total revenue of expenditure exceeds the total revenue receipts of the government. Fiscal deficit is nothing but when the total budget expenditure exceeds the total receipts minus the borrowings. So that's fiscal deficit. And primary deficit is defined as a fiscal deficit minus the interest payments on the previous borrowings. Primary deficit shows the borrowing requirements of the government for meeting expenditure excluding interest payments. So primary deficit removes interest and fiscal deficit removes the borrowings. So the way to finance deficit is of three ways: borrowing from the public and the foreign governments, withdrawing cash balances with the RBI, and borrowing from the Reserve Bank of India. So these are the few basic points that I wanted to share with you with regard to the budget, with regard to your budget. And few other topics which I wanted to tell you is about Article 1114, which says that there is, okay, I've already discussed this with you, but yes. So just a moment. On 114, 266 deals with the constitution requiring the government to credit all the revenues received by it, including the taxes and revenues, into the Consolidated Fund of India. 266(2) deals with requires the government to withdraw the money from the Consolidated Fund of India after being authorized by a law, that's the appropriation law. 270 requires the government to present a statement of estimated receipts and expenditure of each state government, that's called as the state budget. 272 requires the government to transfer certain specified taxes and duties to the states and union territories. And these are few of the articles which deal with the budget. So these are the points that I wanted to share with you with regard to July 22nd for your budget. If you did find them helpful, please do like, share and subscribe, and don't forget to comment at the end of the video. And I shall see you tomorrow with another new list of important points that you need to remember for the upcoming UPSC preliminary examination for July 23rd. And until then, it's very happy learning.